We now begin session titled Climate Finance Today, the Failure and the Imperative. Our speaker is Professor C.P. Chandrasekhar, Emeritus Professor, Center for Economic Studies and Planning, JNU. The session will be moderated by Mr. Kundan Pandey, Senior Editor, Mongabay, India. May I invite the speaker and the moderator to the stage.
Good morning, everyone. Am I audible? Yeah. Okay, so whenever climate discussion happens, we hear big numbers, as we just heard by CV. So trillions required for energy transition, billions agreed in COP negotiations, multilateral commitments, and private finance mobilized. And yet, despite decades of negotiation, private finance remains one of the most contested and underfulfilled aspect of global climate governance. Developing countries continue to argue that the committed finance remains to be materialized at the scale required. And there are concerns about additionalities, climate debt, conditionalities, and how to balance between mitigation and adaptation finance. And at the same time, developing economies like India faces dual imperatives. On one hand, they must align to low carbon pathway. On the other, they have a big job to do. They must sustain development, employment, and macroeconomic stability. This raises a number of important questions. Is the global climate finance architecture fit for the purpose? Or it has failed structurally or just merely delivered not up to the expectations and some improvement can work. And the third question is whether reform is needed. And if it is needed, how should it look like? Especially from the perspective of Global South. So to help us reflect on these questions, we are privileged to have with us Professor C.P. Chandrasekhar, whose work on macroeconomics, financial system, and development provides us a critical lens to see the political economy of climate finance. Professor Chandrasekhar taught for 4 decades at the Center for Economic Studies and Planning at Jawaharlal Nehru University, New Delhi. He is currently Senior Research Fellow at the Political Economy Research Institute at the University of Massachusetts and Global Director of Research and Policy at International Development Economic Associates. He is the author and co-author of several important works, including Crisis as Conquest, Learning from East Asia, The Market That Failed, Neoliberal Economic Reforms in India, Demonetization Decoded, A Critique of India's Currency Experiment, and Karl Marx, Capital and the Present. It's a collection of 4 essays. So he's also a regular columnist for Frontline, Business Line, and the Economic and Political Weekly, where he contributes articles contributing significantly to debates on microeconomics, finance, and development. We are fortunate to have him with us today to reflect on climate finance today, the failure and the imperative. So, Professor, may I invite you to deliver your address? I'll request you to conclude your remark in 40 minutes, and then we can open the session for question and answer.
Thank you, and thanks to Kushbu, Mr. Sashikumar, the MDF, the Asian College of Journalism, for giving me this opportunity. Now let me see if I can get this working. Okay, so what I'm planning to do in this 35, 40 minutes is really to lead up to one question, and that question is, it's very clear now that if we look at the global climate finance landscape, it's a landscape in which governments have, in some sense, abdicated their responsibilities, and increasingly the presumption is that the private sector or private capital would be able to fill the gap if supported in particular ways with state funding. And I just want to sort of lead up to how we arrived at this situation, and then to try and assess whether that's a feasible option or not. Now, firstly, of course, we are not dealing with something which is very tractable, as was mentioned. Defining climate finance is very difficult. It's not only difficult because of the fact of we are looking at which outcomes are outcomes of a kind in which the project concerned can be identified as a climate project, and therefore the finance associated with that project can be identified as climate finance. It also is not so tractable because of the fact that at the point of time when you identify a target of climate finance, you're presuming that this would deliver a certain set of outcomes over a certain time profile. That is, it's not that you've actually had a situation in which you monitored to see whether the outcome has been realized, whether there's been some kind of climate or greenwashing of the project concerned. But really, the moment the project is identified as a climate finance project, independent of the fact that it is delivered or not, which of course occurs only in the future, it already is included in an estimate for a particular year or financial year, identifying it as climate finance, which makes it even more difficult because of the fact that you not only have the problem of identifying which is a climate finance project or a target of climate finance, but more importantly, you're not in a position to be able to establish that experience has shown that that assessment was actually warranted, even if it was correct. So therefore, we are dealing with something which is intractable. But broadly speaking, what is the global, what is the global financial landscape? It basically is defined by the sources and directions of flow of resources, which are supposed to, sort of support these activities, these projects and activities, which are designed to mitigate factors which lead to climate change, and of course to enable adaptation to its effects, its ongoing effects, which are already being experienced. It's not a 2030 or a 2070 net zero kind of promise. It's already being, so you need adaptation currently as well. But more recently, there's also been a certain degree of emphasis because of that ongoing impact on the need to compensate for loss and damage. And the understanding is that climate change which has already occurred, warming which has already occurred, is already resulting in extreme weather events, whether it be floods in Pakistan, or whether it be rising sea levels which affect island economies and so on. These things are already happening, and in order to be able to adapt or to sort of compensate people for the adverse effects of that, we need to actually take into account loss and damage as well. In any understanding of what exactly would be the total requirement of climate finance. And that makes it really, really difficult because of the fact that we are really thinking of what could be the consequences of ongoing climate change or global warming, and therefore how much should be provided for to those who would be affected. Now, the thing is, when we look at this landscape, we're basically talking about a set of, and that's important for us to keep in mind, we're basically talking about a set of flows which can either occur cross borders or it can occur within national jurisdictions. So you can have a government which actually decides to fund a set of projects which it sees as part of the need for mitigation or adaptation, or you can have international governments funding in third countries through multiple channels, either bilateral or multilateral, funding in order to be able to actually get those countries to actually deliver on this global public good, which is obviously something which is good for them as well. But more importantly, cross-border flows, we know in the discussion, are important because of the fact that there is a difference between the degree of responsibility for the extent of carbon emissions, cumulative carbon emissions, and in fact, even currently, there is a difference in terms of per capita emissions. And of course, if you don't look at the emissions of particular nations per capita only on the basis of their own production, but also on the basis of their own consumption, because of the fact that it is in the nature of globalization that it relocates economic activities to low-wage locations, and therefore you actually move production, which can be sort of emission intensive, let us say, to another location, but you're consuming the products which come out of that in many cases. So if you take all of that into account, you're basically saying that there is a significant asymmetry in terms of both the cumulative and the ongoing contribution to carbon emissions. And if you're basically saying that we have some target, whether it be 1.5, 2 degrees, whatever centigrade is the maximum we can take, there is a carbon budget. And if you're saying there is a carbon budget, we know that the argument has been that already a significant part of that carbon budget has been occupied since the days of the Industrial Revolution by these countries which are predominantly responsible for the state we are in. Now, if that is the case, and also we take into account the consideration that having undertaken those emissions, these countries have over a period of time both accumulated significant amounts of real wealth and utilized those real wealth to deliver to themselves the per capita incomes, which leads to them being identified as advanced nations. Then we are saying that in some sense, the fact that they are advanced nations is linked to the fact that they made these contributions to the carbon budget or to global warming. And therefore, you have a situation where, particularly if you go with the understanding which was held for a long period of time by the structuralists, the dependency theorists, a whole range of other writers, including, of course, those from the left, Marxists, etc., that in some sense, development and underdevelopment are not two independent things. That development and the pole, particularly once you take colonialism into consideration, development at the pole was actually possible because of underdevelopment at the periphery. Okay, so in some sense, you're saying that you generated a situation where there were a set of countries which neither contributed as much as the current-day advanced nations did to global warming, but it also created a situation where the ability of those countries to be able to generate from their own production and economic activity the surpluses needed to finance mitigation and adaptation efforts within their own jurisdictions has got undermined by this long history since the Industrial Revolution, because of the fact that capitalism has always been global and capitalism has always been characterized by the fact that either through coercion, as under colonialism, or otherwise, you've had a situation in which development at the core has been linked to underdevelopment at the periphery, so that we ended up, not because all of this was recognized, but we ended up with the need to in some sense, admit that there is a set of combined and differentiated responsibilities and differences in capabilities, so that this whole notion of CBDR, of combined and differentiated responsibilities and respective capabilities, came to be a part of the Paris Agreement in terms of how you need to address climate change or global warming. And addressing that, I mean, an essential element of that CBDR was the idea that a significant part of the finance needed to address climate change, whether in terms of mitigation or adaptation, had to be on the basis of cross-border flows of capital, and not necessarily, not just on the basis of each jurisdiction trying to find for itself the resources which it can outlay in order to be able to deal with climate change. So what that meant is that there was need for a much higher financial contribution from the developed countries through both bilateral and multilateral channels. Now, finance is needed, actually, if you look at it, for those of you who've heard of the Bridgetown Initiative, which was Mia Motley and Avinash Prasad and so on, who tried to identify a set of ways in which they can get the international community to agree to a set of things which countries affected very adversely by climate change but not able to address it themselves can do, that they made a simple distinction, which of course has been spoken about a lot, which is that there exists in some sense three sets of areas which can be broadly considered to be activities which can help mitigate or adapt to climate finance. There would be one set of activities, as was mentioned by the previous speaker, in which returns are positive and in many cases significant in renewables, in EVs and so on and so forth. These would be areas into which private capital would come. Second, there would be a set of areas in which private capital may not be willing to come without some degree of intervention by the state, whether it be intervention which involves penalties, mandates, as mentioned, or some would argue even provision of certain kinds of subsidies and transfers to de-risk and incentivize investments in these areas. You can think of a second set of areas, and there would be a third set of areas where actually you would be in a world in which returns are in all probability zero. And even if they are not zero, they're going to be so low that they wouldn't attract any private capital. And therefore, these would have to be areas which are characterized by two kinds of financing. Firstly, the financing has to be public. even cross-border financing has to be public. And secondly, that this financing has to be in the form principally of grants, and at most extremely concessional finance, as for example offered by the International Development Association, because otherwise you're not going to be able to put capital into these areas because of the fact that there's no way in which those kinds of investments or activities would generate the returns to be able to pay even a measly capital charge. And therefore what you need is really grants and, as I said, at most IDA-type concessional finance. So therefore, what we are speaking about when you look at the landscape is really to say that there must be cross-border transfers of public finance in substantial measure, most of which must come in the form of grants and concessional finance. Now that is the nature of the animal that we are talking about, as was referred to in multiple ways by the previous speaker. Now on the other hand, if you look at an estimate which we have, for 2 years, 2021, 22, by Carbon Brief in The Guardian, it basically said that of the 17.2 billion, of the 33.4 billion of capital which went to the least developed countries, not less developed countries, but the least developed countries, about more than half of it actually was in the form of loans provided by countries like Japan, France, and the multilateral development banks at commercial terms. So therefore, you're really saying that even the countries which require it most, the least developed countries, were not being offered in cross-border transfers, of course of adequate magnitude, but even what was being offered was not in forms in which it can actually address the climate challenge. Now the thing is, the way in which the whole climate finance debate has been shaped in some sense is it got shaped by a promise made in Copenhagen in 2009, long years back, that by 2020, the Annex II countries, those countries which are actually responsible for a disproportionate share of emissions, accepted that in 2009, they accepted that by 2020, they would provide something like 100 billion, which would flow to these countries per year as cross-border financing, taking into consideration, not admitting, of course, that this is actually a form of reparations, not admitting that there is a responsibility which warrants these kinds of cross-border transfers, but essentially trying to say that, okay, we think that it's necessary to generate a global public good, and we will contribute to these countries $100 billion a year. As we know, that trying to assess whether these $100 billion has been delivered or not is extremely controversial, as it's mentioned. The most favorable estimate of how much has moved from the Annex II countries to developing countries or low and middle income countries is the estimate which comes from the OECD itself. And the OECD basically doesn't only restrict itself to grants or even concessional finance, includes all sorts of flows, and it includes a certain component of what it considers to be private expenditures on climate, which have been in some sense triggered, or they've been sort of extracted by leveraging public flows. So you include that as well, and that's the total amount that's the kind of estimate which the OECD makes. Of course, Oxfam and even the government of India had an estimate which Oxfam, I think, put when they said it was in the range nearing 100 billion, meaning the OECD. Oxfam put it at, I think, something like 25 billion in that particular year. The government of India made an estimate a few years back, virtually saying it's almost nothing. That was the kind of estimate that they put out, the Department of Economic Affairs. So there's this disagreement. But what we know is that even if we take this most favorable estimate, which actually is an estimate which most people don't agree with, it was only in 2022, as opposed to 2020, we are told that this 100 billion figure was exceeded by a small margin. Otherwise, it was always been short. And this matters because of the fact that the understanding was that not only would you achieve the 100 billion by 2020, but then you would actually have a new set of negotiations or a new set of discussions which would go on to arrive at this oddly termed NC, that is new collective quantified goal that's going to be discussed to actually see a significant jump up in the amount of climate finance which would go on a cross-border basis from the Annex II countries to the developing countries. And we know that this was finally taken up in Baku, the COP meeting in Baku, which is identified as a climate finance COP, Conference of Parties. And at the end of it, what was offered was that the estimate, I mean, as was mentioned, there are very widely ranging estimates of what is required. But the developing countries, or the low and middle income countries, wanted something like $1.3 trillion per year for just on these cross-border flows from the Annex II countries to the low and middle income countries. What was offered, of course, was only 300 billion, that too, which is going to be realized by 2035. If you apply some kind of a reasonable inflation rate, we are talking about, depending upon the inflation rate you choose, one is, if you compare it to what was offered in 2020, which was 100 billion, that is, you calculated the 2020 prices, you're talking at something like 180 billion. That's where the increase is from 100 billion to 180 billion. And of course, if you look at it in terms of 2035 prices, what it's going to be if you get to 300 billion in 2035 in terms of 2020 prices, you're actually talking about something which just about exceeds 100 billion. So there is no real new goal which has been put in place after Baku. But the way in which they got out of this was to say that, listen, this 300 billion will then be used to leverage another 1 trillion worth of private flows to these countries from the north to the south. So the whole idea was that we are moving from a situation in which the responsibility for carbon emissions cumulative on the part of the developed countries requires them to make transfers to the less developed countries, which were in some sense an underdeveloped periphery as a consequence of development at the core, that this is actually going to be a situation in which we're going to that we need to make these transfers. As opposed to that, what you're saying is, no, we're not doing that. What we are trying to do is to actually create a situation in which private capital would be leveraged or mobilized on the basis of the public finance that we provide on a cross-border basis. Okay, so I'm sorry, I've not been moving this. Okay, so and this, now the thing is, if you look at the figures which we have from Carbon Brief and Guardian, just look at it. The interesting thing about the 2022, in which we saw the realization of this target, this 100 billion target 2 years late, is because of two things. One is, of course, is a significant step up in the US contribution. And two, I told you, the OECD increases private finance mobilized. So there's the private finance mobilized component and the US component. What is the US component? The US component is really what happened under the Biden administration, which actually decided that both from the point of view of the need to reestablish, in some sense, the competitiveness of the American economy. So you had a whole host of subsidies which they decided to provide through the Inflation Reduction Act within the United States. But as a part of that whole climate initiative, there was a certain upping of the amount of transfers which are going to be made by the United States, which was surprising considering the past record. And these two really accounted for the fact that there was a significant step up in 2022 to realize that goal. Now, where are we now today? Where we are now, much of the otherwise you see, it's Germany, France, Japan, so to a certain extent the UK and the rest of the EU, which is responsible for climate finance. Where are we today? We are today in a situation in which actually if you look at it, there's serious climate finance fatigue. Under Trump, they pulled out of climate completely. The United States has pulled out of climate. There's going to be no money which is going to come in because they say that this is a big confidence trick, a big con, all this climate finance debate. If you look at Europe, much of Europe now has decided that because of the fact that NATO is not going to be supported by the United States, that they need to up their defense spending. Earlier, the guideline was 2% of GDP. Some of them want to go to 4% and 5% of GDP. If you move your monies into defense in that manner, you're not going to get even what the EU and the EU countries and to a certain extent Japan, which is also going to militarize. So you're going to be in a situation where, where this is not going to be realized even in terms of possibly the 100 billion that we're speaking of, okay? Now, so given that, where are we at? We are in some sense at this last element, that you're basically making the climate, that you're changing the climate finance landscape to make the climate financing process one of attracting private finance through innovative means. Now, what is this context for innovative finance? First, of course, there's huge volumes of liquidity being intermediated by the world financial system. So I've put some figures there. If you look at it in terms of total bank assets, intermediaries, etc., you're talking about many trillions. There's something like 483 trillion out there. The world GDP was around 105 trillion in that year, or 22% of the stock of finance. And the wealth of the wealthiest 1% was something like 49.3 trillion. Okay, so if you put a 2% tax on the wealth of the wealthiest, I mean, you're going to generate a lot of money as the European Tax Observatory has seen. Now, what is the challenge? The challenge, of course, is the belated recognition of the seriousness of climate, as was pointed out. So if you take estimates which vary between 5 trillion and 8.5 trillion, as was mentioned, I mean, these estimates are, there are many of these estimates floating around, but if you take these estimates of what it would be needed, on a conservative basis, then you're talking about 1.1 to 1.7% of global financial assets. So basically the argument is, well, the money is there because look at it, look at the amount of money which is being mediated by the world's private financial system. And if you look at estimates of total climate finance from Climate Policy Initiative for 2023, it was at 1.9 trillion, and a close to 1 trillion of that came from between 2020 and 23. So yeah, it's growing, and the private sector can play a role. Now, I just want to point to 4 mismatches here which need to be addressed if we really are going to take the discussion on climate finance seriously. The first is, of course, the location of the available financial resources and the location of the need, as was mentioned, for those resources. They're concentrated in the hands of a few financial institutions located in the metropolitan centers of global finance. But if you look at estimates, the estimate is something like 2/3 of the future collective climate investment will have to occur in developing countries, because that's where you're going to have to do a lot as they begin to develop in order to be able to ensure that you can have a just transition of sorts. So if 2/3 have to come there, but the money is concentrated in private hands in the developed countries, you have this mismatch between the available financial resources and the location, between the location and the need for those resources. The second mismatch is the yield-seeking character of those resources and the low average returns on these spendings dictated by climate finance needs. Now, as I've already mentioned, some of this can come through private investment because they yield profits which are significant. As was mentioned, the risk-reward combination is pretty good. But then there would be other areas where it would not. So, and this would be even more true of adaptation and, of course, of loss and damage compensation, which is the demand for reparations, really. So, what you would need is public funding, but the Climate Policy Institute, people have questioned its estimates, but anyway, 1.9 trillion, out of that, 1.3 trillion came from private sources. So you really are saying that, look at it, it's really private sources which seem to have provided, if you go by this estimate. The third mismatch is between responsibility and commitment. So there is the unwillingness of those who are responsible, which is what I'm talking about in terms of the achievements, and now the climate finance fatigue that we're observing, to deliver on their obligations based on the polluters must pay principle. That's the principle which I'm sorry to say I'm an economist, so us economists have not only said the polluter must pay. So, and that's what makes CBDRRC central. I mean, the combined but differentiated responsibility in respective capabilities, but we know what we got. And the fourth mismatch is that while the state is the best channel for location of the resources to facilitate discretionary spending for social benefit, because we are not talking about global public goods, we're talking about investing for social benefit, there are ideological obstacles to the transfer of those resources to the states and to their use of such resources. What are those ideological? One, of course, is the very rise of private finance creates constraints on transferring resources to the state. So there's an opposition to taxation. There's an opposition to any proactive fiscal policy. You can't even borrow and spend. And that stems from the dominance of private finance. And the rise of finance limits domestic fiscal space because, you can't tax. You, in fact, have to provide subsidies. But what it does is it's placing demands on the available fiscal resources because you're saying that, listen, you need to de-risk and incentivize us to come enter into these activities because we are profit-led, yield-seeking, sources of capital. And if that be the case, if you want us to go into areas where there isn't that and the risks are high, you must de-risk those areas as well as you must, in some sense, incentivize this investment. So what would be otherwise a means of mobilization? The normal means of mobilization would be those which are penal, which are direct and indirect taxation measures. One calls them penal because that's the way the private sector looks at it. This can be national and global. You can have market-mediated taxation of carbon, inversion of the polluter pays principle, by focusing on aggregate current emissions. You're saying that how can I, in some sense, put some kind of a carbon tax, which is, a version of the carbon price, but this is a carbon tax. And you can have negative taxation, which is you can say that, okay, let's reduce subsidies. This huge example, fossil fuel subsidies is given. So that's the way in which that would be something which is, you can say, is more penal from the point of view of the private sector. What are the incentives? First is, you say you must incentivize by providing unfunded full or partial guarantees. You're basically saying that, okay, you issue a bond, in order to mobilize capital from the private sector, and you basically say, the state would say that, listen, if there is any failure, any default on the payment of these bonds, either for the full amount, we'll pay the full amount, we provide a full guarantee, or you can pay a partial guarantee. You can say, I'll take the first loss for the first 30% of losses, and when you do that, these instruments become less risky. If they become less risky, they get a higher credit rating from the credit rating agencies. If they get a higher credit rating, then it would be possible for institutions like pension funds, insurance companies, etc., to invest in these bonds. So you de-risk this kind of activity by using the funds of the state. Okay, you can have profit creation or protection through transfers. You provide direct transfers to the private sector, and you offer, as opposed to fossil fuel subsidies, you offer subsidies like the Inflation Reduction Act in the United States does. You offer subsidies on activities which actually promote guarantees. Now, what would be a really good proposed solution? Obvious solution is taxation. But the limited discussion on mobilization through taxation, is because of the fact that, you always divert the argument. You say, where is the money? Okay? And then absent the willingness of the transfer from north to south, which is what is required, the needed consensus on, a major role for the private sector is seen as inevitable. So you move it in that direction. So if that be the case, what we have is, human ingenuity, it's argued, is not needed primarily for technical innovation needed for mitigation. What we have to do is think of innovative financial solutions which will bring all this private capital into climate finance. That's the way in which you have transformed the climate finance debate. Now, so you basically, think of all these structured financial transactions, which I'm not going to go into, but that's supposed to be the innovative instruments by which you can incentivize private capital to finance climate-related spending. And underlying that are explicit or implicit transfers from the state to the public sector. So the forms in which public capital is sought to be used, one is viability gap funding. You basically say that, okay, I know if you invest in these areas, you'd get only so much of a profit or you'll get a loss. Therefore, I'm going to cover the difference such that you get a yield which is acceptable to you. That's the viability gap funding model. You can have part coverage of capital expenditures with junior rights to any profits generated for the state. It covers the capital expenditure. This is prone to what's called gold plating. You hike the capital cost, and therefore, in essence, what the state is doing is financing the whole of the capital costs. You have guarantees to catalyze climate financing, which of this kind that I just mentioned. And you can use, use aid, development aid, as we mentioned, for things like debt for nature swaps or debt for climate swaps. And often this occurs through a bond exchange program. Countries which are indebted in foreign exchange terms, you give them a discounted bond exchange program, and you basically say that this is going to be associated with you taking the difference in money in local currency and investing it in some kind of a nature-based or climate-based activity, but using your own currency because we are writing off a part of your debt. So now what is the dangers here? First of all, it's not clear what is innovative in these forms of financing. Versions of this have always existed after the 1980s in financial markets. So you're basically saying, subordinate climate to what the financial markets have become in the period after deregulation and liberalization of the 1980s. It took a global financial crisis in 2008, which precipitated the Great Recession for arch-conservative Paul Volcker. Paul Volcker was responsible for the Volcker shock, which pushed up interest rates to 19%, after the 1970s recession. And he was forced to say, he said the most important financial innovation he had seen at that time, it's 2008, in the past 20 years is the ATM, He said, what is all this financial innovation? I don't see any financial innovation here. Now we want to import financial innovation into climate finance. And we know that what actually financial innovation, financial engineering did was to give us these opaque and toxic structure adjust. And similarly, what is happening today is private climate finance is being similarly rendered opaque. Well, it's also costly, because these are all structured transactions. One company, one financial firm, which was very involved with these kinds of activities, which is Credit Suisse, actually failed finally. It failed and was taken over by UBS, but Credit Suisse is an important player in structuring these financial transactions. And when you bring in them, or you bring in the International Development Finance Corporation to offer some kind of a guarantee, there are guarantee fees to be paid. There are fees to be paid to the financial institution which structures the transaction because it's bringing in expertise, etc. And you end up with a situation where actually the cost of just generating these sort of instruments, which are supposed to mobilize climate finance, goes up hugely. So you're actually taking public funds, either putting it in viability cap funding or in private partnerships or in providing subsidies or paying off sections of the private sector to actually structure innovative financial instruments. So what would happen is the ratio of private capital mobilized to public resources would not be very significant and economically defensive. The subsidies would be non-transparent and unreasonable, and public resources can be diverted to de-risk public-private partnerships, curtailing funds which are actually needed for really low return, high social benefit climate finance projects. So the thing is, I'll just stop with this, which is, you see, the epistemic community of global finance, in whose hands, that's the location of the money, in whose hands the surplus rests. It's not a neutral player, sort of passive recipient of signals from the state, oh, you do this, and they go about doing it. It's a community that seeks, and the great case of this was GFANZ, which is the Global Financial Alliance of Net Zero Financial Firms, and that happened in Glasgow. And all these, Carney, who's now, of course, Canada's president, was then post his role as the head of the UK Central Bank. Carney was in charge of GFANZ, and he said, oh, there's trillions of dollars which are going to come in. We've got so many members, insurance companies, banks, financial firms, etc. It's completely broken down. All of them are withdrawn, and they're withdrawing even faster now because of the fact that Trump has said that, listen, if I see you playing around with all this climate stuff, I'm going to get at you. So you actually see a complete breakdown of that. you basically, then you have, what is happening now that this epistemic community is trying to subordinate available or discover new areas for generating profit, and climate finance is becoming one of those areas. It's becoming a place of play for global private capital. It lobbies for and coerces action out of the state. It fights against state regulation. There's all this talk about blended finance, etc. So what is actually needed? I mean, even if we accept that the private sector can play a role, what is needed is actually innovative regulation of state-supported projects, so that you can actually see whether the money which the state is providing in order to, in some sense, incentivize and de-risk private capital is actually going to deliver a set of projects. So there must be monitoring, scrutiny, and penalties if you don't get that. So you need innovative regulation and not innovative finance. But the point is, the moment you start speaking of anything like that, you're actually going to see, as happened in the case of GFANs, you're going to see the withdrawal of all significant private players. Who are the locations of these resources? And that would essentially mean what? What we're saying is that if you actually look at the global financial landscape, after having sought to, in some sense, subordinate it to the needs of private financial capital, which dominates capitalism today, what we're seeing today is a complete breakdown of climate finance itself. It's a breakdown which comes because of absent leadership in the global north to ensure that there is an adequate amount of cross-border, grant-based flows to the low and middle income countries, such that you can actually move along a trajectory where we can make a difference to the extent of global warming, and hopefully stop it at a level before it's far too late. Thank you.
Thank you, Professor, for insightful discussion and the lecture. You talked about who has contributed to the climate challenge and how developing countries are expected to contribute, and how CBDR came into the picture, how the climate finance get into the scene in 2009, what is the best case scenario, how they are counting the finance, and now what does it mean, like what have been agreed in Baku during COP29, what does it mean? I think nothing. That way, it is just like $100 billion, the previous commitment. Then you also talked about four mismatch, like where the location is, where the financial resources are, and where it is needed most. Then you talked about the unwillingness of the responsible people. And then you discussed how can finance be mobilized, what government can do. And you also highlighted the gap and also challenged the idea of innovation, what is very popular these days. But then you said what government can do, and we need innovative regulation and not the innovation in climate finance. So thank you for this. Now we'll open for the question and answer.
Hi sir, thank you for such great insights. My name is Arjun Gupta, and since we are talking about climate finance, so one of the things that comes is sovereign green bonds released by RBI. So recently we have seen that RBI is not able to get the greenium from investors, and in the past one or 2 years they have to even cancel the green bonds. So why is that happening? Why don't we have investor trust when it comes to green bonds, and why are the investors not accepting lower yields when it comes to green bonds? Because this is what we portray in the international forums, that by releasing green bonds we are doing enough and raising capital for green projects. So why is that happening? And what can the government do now? Should we go for tax breaks, tax exemptions, more foreign inflow? So what can be done regarding that, sir?
Why do green bonds not necessarily take off? Let me put it this way. First, I don't know if you heard of this gentleman called Tariq Fancy. And Tariq Fancy was was BlackRock's person in charge of ESG, that's environmental and social governance, including climate bonds and so on. And Tariq Fancy quit BlackRock and then wrote this sort of monograph in which he was pointing out that how the whole ESG movement is one in which actually what was really surprising about ESG was ESG bonds were very often performing better than non-ESG bonds, because the whole idea of ESG bonds is you're supposed to attract those people with a conscience. I mean, private capitalists with a conscience. You're saying that, okay, here's a bond which is actually going to contribute something for environmental or, some social development goals. And therefore, please put your money here. We'll try and get you a reasonable return, but it won't be, it won't be. But you ended up, Tariq Fancy said, that's because of the fact that they basically did this in order to attract this capital, but they still want to get their commissions. They still want to, do well in that market. And you ended up with ESG bonds becoming much more successful, and then very many normal bonds which were being issued by private financial institutions. And he basically said that if you look at all of the projects which are supposed to have been implicitly, at the beginning, been the target of funding of these ESG bonds, that they were all completely greenwashed. And he was saying that what you're actually doing, and which is what I like best about what he said what you're actually doing is you're distracting attention from the role of government into actually adopting policies which will force private investors into being more climate responsible, by actually saying that, oh, it's okay, you give the money to these, to your BlackRocks or, whatever it may be, Alliance Capital or whatever it may be, and they would do the job for you, and you can feel good that you've contributed. Now, looked at in that sense, supposing there's an entity which is actually not a private entity, and which is saying that, okay, I'm going to issue green bonds, then I suppose the presumption would be that at least a public entity would actually put the money into projects which would deliver green outcomes. That would be the prime objective. The prime objective is not to give you a return. So if I am actually an investor who's looking for returns and is not actually just trying to be good because of the fact that I think I should contribute to the green future of the world, then what I'd say is, listen, why don't I go for this other bond where there's no such risk that the money is going to be put by this entity. You didn't have that risk in the case of the ESG bonds in the private sector, because everybody got to know very soon that, hey, BSG is a good thing, because it actually is doing pretty well, and obviously they're putting the money somewhere where the money works. Whereas if you put it, money works in terms of money. But if you put it into projects where money is going to work in terms of green outcomes, then possibly, you could even possibly get defaults. So the normal tendency would be for private investors, and if you happen to be in a market which is not pretty, which is pretty shallow and not very wide in terms of investors, which is what the Indian market is. There are a bunch of wealth holders who invest in these kinds of bonds. Maybe, I don't know, maybe one of the things is they said, listen, why should we put our money here? Let's go and put it somewhere else where things are clearer. That could be the reason. What could be done, I think all market mediated, even carbon pricing, finally, there's a question of what price of carbon, or carbon emissions, 1 ton of, emissions, what price would actually prevent the private sector to move into areas which are more emitting, or let's say not, or even emitting at all. And the estimates vary. Stiglitz and, normally people talk about $7, $13, $18 and all. Stiglitz and Nick Stern, they did a report on carbon pricing which said that it has to be $100. So you don't even know, because the point is, otherwise what, in an oligopolized world, you price carbon, the person would emit and pass the price down, because I control the market. I'm a market, price maker. I'm not a price taker. So it's, market mediated mechanisms should go, and you basically, you need to have mechanisms by which, that's why I said there are penal ways of raising resources. Finally, the money has to come through, if the surpluses are located in the private sector, and the surpluses have to be moved to the public sector to have meaningful climate finance, then there must be forms of taxation which appropriates the surplus and places it in the hands of the state. to try and coax, cajole. I mean, private Indian banks were being coaxed and cajoled by the Reserve Bank of India from 1947 till 1969 to actually move some of their money, like the State Bank of India, which was, of course, a nationalized imperial bank, was doing, move some of their money into lending for agriculture and lending for small-scale industries, etc. In 1967, 2% of the total advances of the scheduled commercial banking system other than the State Bank of India went to agriculture. When agriculture share in GDP must have been, at that time must have been 50% plus, So it's very difficult to coax and cajole a private sector into doing things they don't want to do. You need the state to come in. Yeah.
Sir, since we are talking about banking and you talked about agriculture, so can there be a solution where, or can there be a prospect where we include green financing, especially in private sector banks, or for a matter of fact, Indian banks? Can we include green financing into priority sector lending as well?
Yeah, but then you see, if you include in priority sector lending, it's also what's the interest rate. I mean, if you have an interest rate subvention, if the state says, listen, okay, you're saying that you need to charge 9% if you have to cover, have a spread which covers your intermediation costs, etc. I mean, I'll say 7%. Then what I'll do is I'll give you 5%. You only charge 2%. So making it, I'll give you 6%. But then we have to ask ourselves the question, do you want the thing to be lending to people to do that through the banks, or is there some other way in which the state can directly go to instead of going through a financial intermediary? If it is a public sector bank, yeah, maybe it's the financial intermediary is also implicitly the state. But if it's a private bank, as it is in many countries, and is becoming more and more so even in countries like India, then you have to see whether that's the best channel by which you actually use interest rate subvention in order to reduce the cost of capital for these activities.
Sir, just one last question. Okay. Sir, you sort of countered the argument that developed nations make, that we are the emerging markets, the developing nations, we are high emitters. For example, India is the third largest emitter when it comes to carbons. So this is the narrative that we discussed today as well when we compared India and Europe. But you clearly mentioned that it's more about emission per capita. And when we talk about that then the script is completely flipped. We are way down the line. So how can India counter, how can we put forward this narrative at the international stage? Because they were developing, they were emitting carbons. Now once they are developed, they are asking us to lower down our emissions, which is very difficult for a developing country who focuses on labor intensive jobs and manufacturing. So how do we counter that narrative, especially what you mentioned today?
Well, you can counter that narrative. How successful you would be in countering that narrative is the question. But we must also recognize one thing, that there are two, as I said, you can have cross-border financing, and you can have financing within national jurisdictions. Because it's not that India shouldn't mobilize money of its own to actually undertake. All the money has to come from Annex II countries. But the point is, even the little amount of money, I mean, and this was mentioned, that even the little amount of money which comes basically goes to the middle-income countries. It goes to countries like India, Egypt, and so on, because, I mean, I don't know, is it that they tape the system better, can put up project proposals which are easier for the different channels through which these funds flow to provide them the finance. So it so happens that these countries which are being told that, listen, I mean, you reduce your emissions and all that, they might not even beyond a point be too pushy. I mean, India has been to a certain extent, but they might not be too pushy beyond the point, because they say, anyway, we are getting a bigger share of whatever they're giving, So let's keep that there and then find our own ways of doing this, because we can mobilize some money. It's really, I mean, it's really countries, I mean, Bridgetown Initiative and so on are coming from countries which can't, they're islands, I mean, some of them are coral atolls, and some of them are landlocked countries, I mean, so those countries need the money, so they would push much. The African group is always very vocal, but so in India, I mean, as I said, you can make the argument, but I mean, I would say that the first step is to get low and middle income countries solidarity at all points of time. such that you can actually push for an agenda. And I mean, be unwilling to accept a whole set of other things which are pushed through other means. You know, you take an IMF loan, or you this, then you know you're forced to make changes to attract capital of a different kind by incentivizing it. You know.
Okay, so there is one question online. Why does not government target low-hanging fruits, such as requiring all newer city taxi fleets to be all electric? This will drive EV chargers automatically.
Actually, you should be answering that question. Why can't it? You know, I mean, I mean, it can. If it, I mean, I'm sure it's not that it can't. Come on. In Delhi, they said that, you know, you should remove cars which, diesel cars which are more than 15 years old off the roads, you know. Of course, what people did is sold it to some other city, you know, where they continue to fly for another 20 years. But they did that, and so I don't think that they can't do it. I suppose, I mean, you're more sensitive to certain kinds of things in an election cycle than other kinds of things. And what maybe you're sensitive to push this kind of thing might actually make you lose a certain degree of whatever, constituency, voter support, or whatever it may be. So, but in principle, I don't see why they can't mandate that there has to be, or you can at least say at the margin, you know. So you say, okay, you get rid of your vehicle in 15 years, and at the margin. But then you must also find ways of making those more affordable. You know, if the price is 3 times what you'd pay for a normal car, you know, that's also a problem.
Hi, I'm Mahima. I'm a resident with the Climate Media Hub. I had a question. I mean, I was wondering if you had any thoughts on how the recent budget had allocated money for CCUS, which in hard-to-abate sectors, which is largely mitigation, and the proportion of like adaptation mitigation generally seen over the years in how the government looks at in the budgets in the recent years. Yeah.
Yeah, you know, I was also quite surprised by that. Firstly, you know, I don't know how proven are these technologies. You know, so that's number one. And number two, nothing else in that budget speaks of a willingness to put money, you know, into things which only give you some, you know, some not so tangible, obvious benefit into which you can stick a photograph of a great leader. I mean, you know, so I don't. But we must also look at it the other way around. Possibly, you know, most of what is said in the budget is actually not going to be done. I mean, you know, like Sudipto Kaviraj once said that, you know, the ideology of the Congress is that its rhetoric must not be the same as its practice, and that's its ideology. So you can't say, oh, they said, you know, we'll do land reforms and didn't do it. I mean, he said that's what they want to do. They want to. So maybe it's like that, you know, your rhetoric in the budget, I'm going to spend here and I'm going to spend, and then when the revised estimates come, every year, even this year, you go and look at the revised estimate relative to the budgeted estimate. You know, in some cases, no relationship at all, but most cases, much less. So you put another, you know, maybe, you know, 500 crores here or there, you know. But I was surprised too, yeah.
Good morning. My name is Bhagwan Das. Dr. Chandrasekhar, I think she was referring to the budget allocation of 20,000 crores for carbon capture and storage. You have already answered that. But I just want to know, why is it that when we spend for climate mitigation and pollution control, we don't have an independent audit, whether it is a private project or a government project? There are no independent audits for us to know what is the outcome of the money that we have spent. And we are talking about how to raise resources for climate mitigation or to protecting the climate. Why can't CSR be a way by which you know, climate finance can be raised and money can be spent? That's one, corporate social responsibility. The second thing is, when project finance is submitted for project reports are submitted for funding by the banks, as an economist, we know that There are internal costs as well as external costs. Should the project report also include the external cost for which money can be raised either through the banks, from the public, from foreign sources, or from international agencies, so that the damage caused by whoever is responsible for carbon emissions, that is also taken care of through funding as part of the project finance?
Yeah. Why don't we have an independent audit? I mean, of course you should have. I mean, in fact, I think it's not only, that's partly what I'm suggesting should be innovative regulation, that it should not be only audit. See, supposing you do an audit and you say, oh, these people had claimed when they were, launching the project that there would be the following outcomes, and then we know that, or that so much money would be spent and they didn't do it, or the outcomes haven't been realized. It must be a thing where you say that if the audit actually establishes some kind of a shortcoming, because what you're saying is I'm going to deliver in the future. It's like an insurance product, it's a promise to pay. You keep paying the premium, and there's this person across the counter saying, oh, in case you have an accident or in case you go into hospital, we give you money. It's just a promise to pay, and you're paying for it in advance. So here what you're saying is you're in advance declaring something as climate positive. So you must not only have an audit of the outcomes relative to the claims, but in case there is a deviation, there must be a penalty. Otherwise, you can have an audit, and it'll go, it'll be one more of those reports by the, the CAG and so on, which will go and lie around and nothing much really happens. So that's the way in which I see that you need innovative, regulation. I'm sorry, I forgot your second question here. Yeah. See, I've always had this doubt, See, supposing you say that I let you make profit, but then I'm going to tell you that you should do the following things with the part of the profit you get, which is what CSR is. So instead of doing it that roundabout way, I'd say that, okay, I'll just take part of your profit, and I'll spend it the way I think it has to be spent. So why should we leave the money, in the first instance, in the hands of a private player who's yield-seeking, and then tell the private player, you take a part of that money and keep it aside and spend it the way I tell you? Instead of that, just take that money and spend it as a public agency. So I would still say that, then tax, rather than have this faith that CSR will work, and then if it doesn't work, you'll have to find ways of penalizing and so on and so forth. Oh, well, I mean, that is...
Hello, sir. Thank you for that insightful talk. My name is Pooja Patil. So my question is, if we rewind back to 2005, during the Kyoto Protocol, this important idea of carbon credits had come up. Like you mentioned, the idea of the polluter has to pay. It has another element to it that the one who is not polluting would get the credit, right? So fast forward to 2026 that we are today, how relevant is the mechanism today, and has it taken any shape? And if you could break down the mechanism of the entire carbon credit that's happening.
See, the point is, I suppose, how would a carbon market work? A carbon market would work if you basically say that there is a set of credits, there's a certain volume of credits which are being generated, which are validated credits. Okay, because, I mean, as I said, much of, people say, I mean, not that I've researched it, people say much of the credits which came out of the Kyoto Protocol actually didn't deliver what they were supposed to deliver. And then there's the whole debate, should we allow it to continue to persist? Some countries wanted to and some other countries don't. But so basically we're saying that there would be, we are presuming that there would be a supply of credits when it's validated, and there would be a demand for these credits from those who are actually emitting and then need to actually meet some criteria. And the demand-supply balance would be such that the price would go up so much that, and that's how the carbon price gets set, in this market. The price would go up so much that rather than actually buy carbon credits, I would not emit. I'd try to restrict my emission. That's the mechanism, okay? Now the thing is, firstly, we know that there's been a problem with validation. Vera is that's what Aquifera, whatever that firm, and Vera are the two, among the biggest firms. And Vera was seen as having, claimed all these carbon credits, which are a joke, So, but let's say you do get validated, Now, we know in the European case, in the transition period, in the period when they were doing, they actually gave a certain amount of carbon credits in the transition period, okay? And for some strange reason, the demand-supply balance changed so much that the value of carbon credits came down, okay? Then they started saying that, no, then we are not going to anymore do this kind of thing. And the moment they started saying that, actually a lot of finance entered into the market. Because, now it's finance is looking for any tradable instrument, a carbon credit is a tradable instrument. So I can actually speculate on carbon credits, and therefore you began to see this huge volatility in the implicit carbon prices associated with those carbon credit prices. So it's really, it's unclear at all whether you can use market-mediated mechanisms to achieve this. In the case of carbon tax, it's not market. You are actually saying I'll impose a tax for emissions. The only thing is, that's an indirect tax. So supposing you put a tax on people using, let's say, gasoline. It affects transportation prices. It affects many things. So then those who are, advocating for a carbon tax say that, okay, you take part of that money and you distribute it to those who shouldn't be affected by such a tax, because we are aiming it really on these kinds of, actual polluters or those who are generating. So that's sort of less market mediated, but still, it becomes complicated. So I don't know. I would think carbon tax is slightly better than carbon price, but the problem with carbon tax is it's what we, in economics say it's regressive. It's like a value-added tax. It's like GST, if you want enough money to come from a value-added tax, you must tax salt as well, because if you only tax Mercedes-Benz cars, you won't get so much money. So you need to tax mass consumption goods, and therefore it's regressive. Like that, carbon taxes can be regressive. So then you have to think of mechanisms to address the regression post the tax, so that's So I do think, but definitely carbon credit markets, so far the evidence is not that it works.
Okay, so now because we are running out of time, we can ask other questions outside. I have, sir, last question. I had listed number of things, but this is because there are a number of budding journalists sitting here. Given your long engagement with public writing, how do you see the quality of media coverage on climate finance? Do you think journalism adequately captures structural and political economy dimension? You can give some tips to all of us how we can improve our writing.
Excepting for 3 years in my life, I've always been an outsider to journalism, meaning I write columns, but I only worked with the newspaper for 3 years. But yeah, so I think, there's always a variance, But I do think, for example, writing on climate has been far better than writing on economics. Many economic journalists, I think, learn the economics from IMF reports, which doesn't really help. So yeah, I wouldn't say it's been bad, but yeah, you'll have the normal variations in quality. But yeah, I do think that it's important to write about this because the issue is so important. It's going to make so much of a difference to the world. But it's I think I don't know. You have to find innovative ways of making people actually wake up to this, because it's okay. Sashi mentioned the survey which was conducted, and a lot of people said climate matters. That's because they've been hearing climate. It's like everybody says, oh, AI is going to change the world. The evidence is unclear. AI is going to change the AI business. We don't know how much it's going to change the world as yet, In fact, companies which have invested in the deployment of AI, are finding that they're not making any returns because it doesn't make so much of a difference to what money. So like that, I suppose it's, people might say climate and so on, but, at least I feel that it hasn't got absorbed, the fact that this is this is a real present danger, I mean, which is going to, I mean, it's already affecting, I mean, it affects differentially, but it's already affecting. It's not something which is just a future problem. So I think that should be captured, that, this is not something 2070, 2050, I mean, it's there, it's happening today.
So thank you, Professor, for those insightful reflection, and thank you all for making this discussion interesting. Thank you very much.